Bank of International Settlements just came out with a new way to measure the market conditions for key areas of financial markets, including the US Treasury market. And what this indicator is showing right now is that the volatility and the lack of liquidity in the US Treasury market is now worse than it was during the Great Financial Crisis when Lehman collapsed. Ready? Let's dive in. Real quick word from today's sponsor, iTrustCapital. You guys know that I have used and recommended iTrustCapital for a very long time because you can invest in crypto using your IRA. And you can invest in gold and silver using your IRA. This means that whether you want to start up a new IRA and make new contributions to a traditional or a Roth, or whether you have money already in a retirement account that you want to roll over and use to buy gold, silver, or cryptocurrencies, you can do that safely, cheaply, and easily with iTrustCapital. And I'm serious when I say safely because they take security extremely seriously. They never take custody of your assets. They never borrow or lend against your assets. They never let their custody providers do either of those either. They also have an extremely straightforward pricing model. They do not have any monthly account fee. It's 1% for crypto, $50 for gold, and $250 for silver. Given the fact that cryptocurrency is in a severe bear market right now, many people are looking for ways to start buying the dip and getting in at the bottom here, but also people should be concerned about any tax implications that might come along with cryptocurrency gains later on should those assets be worth a lot more. Doing this within an IRA is the perfect way to shield yourself from those tax liabilities. If you do it with a Roth, any contributions that are made are taxed, which means any gains are not. In a traditional IRA, it is the exact opposite. And so IRAs are a fantastic strategy to avoid some of the tax implications you would have in a regular brokerage or regular crypto account. And because they have assets like physical gold and physical silver available as well, this gives many people the option to invest in these alternative forms of money that normally you would not be able to do in a regular IRA or your 401k at work. So I'm a huge fan of iTrustCapital, using it for crypto, gold, or silver with your retirement money. And if you use my link in the description below, I've got a little bonus waiting for you as well. The Bank of International Settlements just came out with a new market condition indicator here, and they show that they have three of them. One of them is for the US Treasury and US money markets, and then the foreign exchange market centered around the US dollar. These are geared to reflect market volatility, illiquidity, and then deviations from standard no arbitrage conditions. Basically, they're trying to come up with more accurate indications of whether there is abnormal stress in financial markets. And here we see the three charts going back to about 2003 here, but the one that we really want to focus on here is the Treasury market. As you can see here, this market got worse from about 2007 through about 2009 here, peaking at right after the Lehman event. There were other spikes here like the equity flash crash, the taper tantrum in 2013, this Treasury flash event, obviously the beginning of 2020 was a big one, but the recent spike and the recent run-up is basically unprecedented here. Yes, obviously it got much worse for a very brief period of time, but it also resolved itself very quickly in 2020 due to the central bank intervention around the world. Also during this run-up, it also got briefly higher right here than we're currently sitting right there. Although two notes about that. Number one, this data is a couple weeks old. And as you can see here from the chart of the 10-year yield, or the yield on the 10-year US Treasury, you can see that over the last couple of weeks, interest rates yields have just skyrocketed. And that's the 2-year, that's the 10-year, the 20-year, the 30-year, all across the curve. Conditions have been getting tighter. Number two, when we go back and look at how fast this is happening right now, how long it's been happening compared to what was going on in 2007, 2008, very different picture. When we go back to 2007, 2008, number one, it was a lot more volatile. it was getting worse and then better and then worse and then better. But right now, since about 2021, it has steadily gotten worse. And recently, it's just been spiking and getting significantly worse very quickly. Now, students of the Austrian business cycle theory are not surprised by any of this. In very brief explanation here, what's going on is that you have an expansion of the money supply that was built on credit. So you have easy credit, low interest rates that allows the money supply to expand rapidly because it allows many participants, including the US government, to take on a lot of debt. As that new money works its way throughout the system, that bids prices up because the money supply increased faster than the amount of stuff increased. So there's more money chasing the same amount of stuff. That makes prices go up. Now, as prices go up, there's a wealth effect. People feel richer, so people spend more, but people aren't richer. All you've done is change the way the purchasing power is measured. You haven't actually changed the purchasing power. Now you think, why doesn't this keep on going? And it's because of the very beginning, how that money supply expanded to begin with, because of the debt. Now you have one of two choices that can happen at this point. Either you can keep on expanding the money supply by forced printing, in which case you get hyperinflation and the currency collapses. Or the alternative is that conditions have to get tighter to stop the money supply from increasing so that those prices don't keep on going up. At this point, conditions start to get tougher, maybe just a little bit, but that's all you need. Because there will be one participant who says, hey, interest rates are going up. I owe debt, so I'm going to pay that off. And just as new debt increases the money supply, when debt is paid off, it decreases the money supply. It takes money that was in circulation, takes it out of circulation to go pay off debt to cancel out that loan. Now we know that every one person's income is another person's expense. And so if one person stops their expenses by paying off debt, they take away from what expense might have been there. That takes away from somebody else's income. Now that person's condition is tighter. They have less income, so maybe they have to pay off debt. Maybe they have to not spend money that they were going to spend before. And so suddenly, with just that one little tip over into tighter financial conditions, that price rise starts to reverse itself because the money supply growth starts to reverse itself because the debt growth starts to reverse itself. It's all connected here and it all follows one after another. This is why Austrian business cycle theory says that the bust is inevitable because of the boom that was built on the expansion of money supply that was built on easy artificial credit. So because the boom was fake, it has to result in the bust. So when we look at this chart and we see conditions getting extremely tight and we see liquidity, or I should say the lack of liquidity, skyrocketing, this should not surprise us. But the question is, what happens next? If there is lack of liquidity building in the system and conditions are getting tighter and are putting strain on the financial system, what happens next? Are we going to get another domino effect of banks falling over? Well, likely no, because the regulatory differences now mean that banks have not been able to get themselves, at least in America, into the same situation as they were in 2005, 2006. Further than that, there's about $2 trillion in the Federal Reserve's reverse repo facility, which is where financial institutions park their cash in exchange for collateral from the Fed. Right now, they're getting a risk-free interest rate on that cash of over 3%. And as soon as the lack of liquidity turns into a major problem, a globally systemically important problem here, the Federal Reserve will most likely lower the rate they're paying to this $2 trillion in the reverse repo facility to push all of that cash back out into the markets. It'll be forced then to buy things, at least like short-term Treasury debt, T-bills. But that will not have any meaningful impact on interest rates, especially the yields on treasuries, especially as the dollar gets higher and higher. We've seen the dollar spiking over recent days, weeks, and months, which means that the dollar is getting more expensive compared to currencies all around the world. And as most international trade is done in dollars, this means that international trade gets more expensive for most countries. So as countries struggle with locating dollars, that means they're going to have to sell something in exchange for dollars. And for most countries around the world, that's going to mean selling treasuries. Downward pressure on treasuries, since it's a bond, means upward pressure on yields, on interest rates. That means conditions get tighter. More and more sellers, fewer and fewer buyers. This is exposing the giant game of whack-a-mole that central bankers around the world have been playing for decades as they think they smash down one problem with intervention, really just leading to a Hydra effect of 3 more popping up that they have to smash down with even more intervention and control. Ultimately, they sow the seeds of their own demise because they paint themselves into a corner where they have to control everything, and you just can't do that successfully without everything falling apart. But as for now, the next couple of months and the next couple of quarters, it looks like we just have to brace for more pain ahead, tighter conditions, more expensive debt, potentially lower incomes across the board with pay cuts and unemployment, hard recessionary times ahead. And if the Fed blinks and indicates any sort of a turnaround, any sort of a pivot, you will be the first to know, I promise. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.